So cash and receivables is a tough one. So let's see. If, as anticipated, the FASB eliminates cash code classification, how would treasury bill be classified? So treasury bill is like a treasury note, except it's not for such a long time. So I believe it most likely would be a temporary investment. What is considered cash? Post-dated checks. That's not going to be considered to be cash. Money market savings certificates, money market checking accounts would be considered as cash. What is the minimum cash amounts that banks often require customers to maintain in their checking accounts called? It's going to be compensating balances. What is the proper classification for short-term paper with maturities of less than 3 years? Temporary investments and cash equivalents. So for cash discount of 1% if paid before 10 days or otherwise 30 days, what does the customer get? They get a 1% discount if they pay within 10 days. What is classified as a non-trade receivable? Dividends receivable. What is included in the trade category? In the category trade receivable. So trade receivable is also known as accounts receivable. Amounts owed by customers for goods. What should be recorded in accounts receivable? I don't know about verbal promises, but receivables from subsidiaries, dividends receivable, receivable from employees. What is correct regarding receivables? Receivables are claims held against customers and others for money, goods, and services. Under the allowance method of recognizing uncollectible accounts, what best describes the entry to write off an uncollected account? I would say it decreases net income. So what is the normal journal entry for recording bad debt under that expense under the allowance method? So first thing first, you would debit doubtful accounts, and then you would credit bad debt expense. So apparently to do a journal entry for recording bad debt expense, you should debit bad debt expense to increase that liability, and then you credit the allowance for doubtful accounts. So the required balance in Wheeler's allowance for doubtful accounts is 36,750 based on an aging of its accounts receivable. The allowance for doubtful accounts grows as a debit balance of 4,200 from earlier in the year. What will Wheeler show as bad debt expense for the year? So if it already has a credit debit in the account, answer is B, 40,950. What is included in the normal journal entry to record collection of accounts receivable previously written off when using the balance method? So you probably debit accounts receivable and credit allowance for doubtful accounts. Um, when you credit accounts receivable goes down. Why is the allowance method preferred over the direct write-off method of accounting for bad debt? I would say it's C, but I'm not exactly sure. What is imputed interest? That's a question I've never heard of. Imputed interest. Applied to loans have zero interest or no interest or kept below. Estrian Road sold $120,000 worth of gold of goods and accepted the customer's 120,000 10% 1 year no receivable exchange. Assuming 10% approximates the market rate of return, what would be the debit in this journal entry to record the sale? Most likely you would have to debit accounts receivable or a notes receivable. If a company cannot determine the fair value of the note of the good exchanged for no, what is and if the note has no ready market, how is the note recorded? I would say it's like the imputed interest rate or like the implicit interest rate. What does the accounts receivable turnover ratio measure? Measures how much has been collected. What is the calculation to compute the accounts receivable turnover? It's net credit sales divided by average net receivables. How is days to collect receivables determined? It's accounts receivable turnover divided by 365 days. The Remington Corporation has accounts receivables of 1,000 at 101. So the only transactions affecting accounts receivable was sales and cash collections of 850,000. What is the accounts receivable turnover? Well, if it's the average, if 10,000 is the average the AR, then it would be 9.7. Okay, so this is a good question. So they had a beginning AR at 100,000. Total sales was 900,000. So we can find the ending AR by calculating the beginning AR plus the credit sales minus how much was collected to get the ending AR. So 100,000 plus 900,000 minus 850,000. So the ending AR is going to be 150,000. So now that we have that, we can actually calculate the receivable turnover ratio, 900,000, with the average accounts receivable, 100,000 plus 150,000 divided by 2. So the accounts receivable turnover is going to be 900,000 divided by 125,000, 7.2. If a company employs the gross method of recording accounts receivable for customers, then what should sales discounts taken be recorded at? It will be discounted from sales. During the year, Turlip reported net sales of 960,000. The company had accounts receivable of 750,000. Beginning of the year, 120,000. At the end of the year, what's the average collection period? So first we'll calculate the account turnover ratio. One point 84615 and divide that by 365. 37 point, well, I guess it's 0.2 days. When a company has cash available in another account in the same bank, how will a company present an overdraft? I want to say offset the overdraft, but huh, okay. Which items should be included as part of accounts receivable reported on the balance sheet? Which items should be included as part of the AR? Allowance for doubtful accounts. Hmm. During the year, Shrike Enterprises made an entry to write off 8,000 uncollectible account. Before this entry was made, the balance of accounts receivable was 100,000. The balance of net allowance account was 100,000. What was the net realizable value of accounts receivable before and after the write-off entry? Well, I'm not exactly sure if it's a credit balance or a debit balance in the account, in the allowance account. But if they've written it off, the balance of the accounts receivable will go down by 8,000. So, so this is pretty important to know. On December 31st, Green Company finished consulting services and accepted in exchange a promissory note with a face value of 800,000. A due date of December 31st, 2022. Stated rate of return 5% with interest receivable at the end of each year. The fair value of the service is now readily determined. The note is now readily marketable. Under the circumstances, the note is considered to have an appropriate imputed rate of return of 10%. Present value of the note and interest combined is $700,530. Using the effective interest method, what is the balance of the note on the balance sheet at December 31st, 2022? 2020. That's a good question. I actually don't know this one. Which rate is used? Well, let's see if it's at the present value. Which rate is used to calculate the discount on a note that equates the cash paid with the amount received in the future on a zero interest bearing note? It's a good question as well. The company has the following financial information. What is the accounts receivable turnover for year 2 round to the nearest 1 decimal point? Accounts receivable turnover. So 10,000 plus 700 divided by 2. 1,000 divided by 8240. 12. Whoops. 100. 10,000 divided by 12. Probably the answer is going to be B. Boy. Oh, this is sales returns and allowances. Oh, okay. So for sales returns and allowances for year 2. 101 divided by AR. Well, I guess we have to get the beginning. Most likely this would be the beginning balance of AR. So 4,000 plus 7,500 divided by 2. Okay. A business realizes that collection from the customer will be impossible. The accountant needs to write off the uncollectible amount using the allowance method. I believe you have to actually debit the bad debt expense actually. No, set the credit. A company has the following items at year end. What amount should be reported as cash and cash equivalents in the balance sheet? Cash in the bank, clearly. I want to say petty, as well as short-term paper. So the answer would be 37,500. Huh. Post-date checks, really? Um, as of December 31st, company has an uncollectible balance of 10,000. The county wants to use the direct write-off method to write this amount off. How would this journal entry be written? Oh, I thought it was debit bad. I thought you were supposed to debit the bad expense first, and then credit accounts receivables, which makes sense. But let's see what it says. Debit allowance for it, and then credit. Okay, but obviously the accounts receivable will be credited. Company wants to assess the effectiveness of a company's credit and collection policies. Wants to assess the effectiveness of a company's credit and collection policies. What ratio should it use? I would say it's going to be most likely the days to collect accounts receivable. Oh, really? Accounts receivables to sales. Company A sells goods for 5,000. Company B with terms 110 at 45. The company A expects that the discount will be taken. Company A uses the net method for accounting. Which amount should Company A record for accounts receivable? If they expect the discount to be taken, gets a 1% discount if paid before 10 days. I would say answer is D. 34. Yeah. 35. A company has current year sales of 500,000, net account receivables 35,000, and prior year net account receivable 43,000. What is the account receivable turnover rounded to nearest one decimal point? So net sales. And then you can calculate the average AR plus 502, 39,000, 500,000 divided by 39,000, 12.8. Company uses days outstanding to evaluate its receivables. Which number should this ratio represent? let's say it's either A, it's most likely face value of 2-year note is 5,000. Both the market and stated interest rates are 5%. The present value, there is no discount or premium. Is it 5,000? No. um, Company has cash in bank of 10,000, restricted cash in a separate account of 8,000, and a bank overdraft in an account at another bank of 3,000. What amount should this company report as cash in the balance sheet? Company has cash in the bank 10,000, restricted cash in a separate account of 8,000. And the bank overdraft of 3,000. So restricted cash is cash that's been allocated for other things, so it can't be touched. Overdraft 3,000. I would say, probably 1,500, 15,000, 10,000. Okay.